Alright guys, so let's talk about Russia and China versus the West. The economic war is getting from bad to worse and it's not going to stop. NATO is going to keep ramping up their financial blockade on Russia. Putin isn't going to back down either. This war of endless inflation isn't going to end. And understand what's at stake here. If the West loses the war, it will be a humiliating defeat. They have thrown the entire book of sanctions on Russia and they provided over $100 billion in assistance. Conversely, losing the conflict will be an existential crisis for Russia. Putin has said it many times before, and now he has confirmed this, vowing an eternal conflict. In our lead story today, Russia says coexistence not possible with Ukraine's current regime. The goal has always been to remove all of Zelensky's military, and they haven't changed this at all. And here's Russia's plan in black and white. It confirms what we have known for more than a year now. They are executing a strategy of attrition with the West. According to their ambassador Miroshnik, Russia could resist NATO as long as needed to defeat Ukrainian forces and that the West would eventually lose interest. So here's the big bet. Russia's betting that they have enough money, that they can generate enough revenue to keep the war effort going, and let's analyze this. Russia's parliament just approved their federal budget. This includes a 25% increase for the next 2 years. Around a third of the spending is going directly towards defense funding. Now, this won't be possible unless Russia's really sure that their oil revenues will stay high enough. Russian revenues are recovering and staying high in 2023. They brought in over 18 billion in September and October each. Oil revenues are nearing pre-war levels again, and because of this, their hard currency reserves are growing. From Bloomberg, Russia's cash inflow gains momentum as oil exports recover. The October surplus exceeded $11 billion for the second straight month. But the price of crude has dropped and euros is just above the $60 price cap. This means revenues could drop in November. And this is critical information because it allows us to preempt what Russia's gonna do. They will likely cut production again. So don't be surprised if Moscow coordinates with OPEC Plus for deeper cuts to drive the price of oil back up. Now you might be wondering, won't that drive the world into recession? A recession destroys demand. Just look at 2008 and 2020 lockdowns, right? And that's true. But if OPEC forces the world into recession through a higher oil price, this will be devastating for the West as well. Can America really justify funding Ukraine in the middle of a recession? So it's now a standoff. It's a battle of financial attrition. Who can provide the most resources to the front without collapsing their economy first? Yes, the US has the ability to print money and borrow endlessly from the world. They can keep issuing bonds, but there's a physical and political limit to how much money they can give. However, guys, we aren't at that point just yet. In a recent poll, 45% of Americans believe that the US government is spending too much money on Ukraine. But that also means over half of the population still supports the war effort. Not only is there the sunk cost fallacy that President Biden subscribes to, there's still political support for the war as well. Lloyd Austin, Defense Secretary, just visited Zelensky with another $100 million, promising more aid as well. So I still strongly believe that Biden will get his money for Ukraine. I don't see the West backing down for at least the next 12 months at the very least, and this will likely continue well into 2024. This could just evolve into a frozen conflict where the West will still send some money continuously to fight Russia. I don't see the G7 admitting defeat to the world. And what's interesting is how Zelensky is approaching the battle for US funding. He is now using the economic argument, the economic angle of how aid to Ukraine increases US production and creates jobs for Americans. And if you think about it, he does make some sense. In the short term, as long as war spending continues, money will keep flowing to the military-industrial complex that adds to the GDP figures. In Q1 this year, defense accounted for a fifth of US GDP growth. Q1 figures came in at 1.1% growth and 0.21% came directly from defense spending. So it's quite significant. The US could kick the can down the road for a little while longer. They could even push the recession all the way till after the 2024 elections. Biden might spend his way towards another presidential win. Now, I know it's unthinkable, but it's not impossible. Weirder things have happened, right? But it's not just the United States propping up Ukraine. Money from the EU is still flowing strong. And I find it amazing that even on the brink of a recession, the Eurozone still manages to find money for Zelensky. But hey, it is what it is. Germany, the declining economic engine of Europe, has pledged $1.4 billion for Ukraine's army. They'll be rolling out another huge military aid package to keep the fight going against the Russians. In fact, Germany is going to increase their Ukraine aid all the way to 8 billion euros. They are doubling their budget in 2024 to counter Putin. The West isn't about to give up just yet. We haven't reached the breaking point. There's an interesting article in the FT talking about a Ukrainian victory by 2025. Does that mean they'll keep pumping money to the conflict for another 2 more years? And it's really bizarre because Germany is now facing a fiscal crisis. The entire economy is facing stagnation. In a story from Bloomberg, German budget crisis deepens with freeze on new spending. The finance ministry is blocking almost all outlays for 2023. We have to watch this carefully. If the spending for Ukraine gets approved, but other parts of spending gets frozen, we'll know their true priorities. The West might be so deep into this conflict that they succumb to the sunk cost fallacy. They could keep piling on more debt at high interest rates, and obviously, this won't end well, and another financial storm is coming. Now, I believe the only way for things to end is a global recession. That could trigger enough political pressure for negotiations to start, and we might be getting closer and closer to that possibility thanks to China. Beijing is making big moves to undermine the dollar and chip away at it. They are taking advantage of the Middle East crisis to slowly edge out the US dollar from global trade. China and Saudi Arabia recently signed a currency swap agreement worth $7 billion, and this is done to shift their non-oil trade away from the reserve currency. Instead of just the dollar, the Middle East will be focusing more on bilateral local currencies. We know that the US has negotiated a 4-day truce in the war. However, it's just a temporary pause to get 50 hostages out of Gaza. It's not a lasting ceasefire, which is exactly what the Middle East wants. Having a truce is good. There's at least some pause to the chaos. It's better than nothing. It's better than endless fighting. But still not enough for the Arab world. And that is what's important in this economic war. Here's a shocking development. Saudi Arabia is now calling for arms embargo on Israel. It was Iran a few weeks ago, but now the king of OPEC is calling for a ban. During the recent BRICS summit, MBS called for arms exports to Israel to stop. And this is a big shift, a big U-turn against Israel. Now obviously it won't really happen because America is the biggest weapons supplier to Israel. But it does set up the stage for the Middle East to break further and further away from the dollar system. And they could impose a huge political and economic cost to the United States. And China is following up with a countermove against the dollar. For many months now, the Chinese yuan has been dropping against the dollar, but things are starting to reverse because the Federal Reserve has signaled a peaking of rates and CPI inflation has come down. The whole world is preempting rate cuts, and this is causing currencies to rally against the dollar. The yuan is now back to its starting point 12 months ago. However, it's not just Fed policy that's driving down the dollar index. China is also actively fighting back in the currency markets. In a report by Reuters, China's state-owned banks are buying back the yuan to hasten its recovery against a weaker US dollar. To boost your own local currency, you are selling down your dollar holdings, and that weakens the reserve currency further. But why is China propping up the yuan? According to Economics 101, a stronger currency means your exports becomes more expensive, and that isn't good for exporting stuff outside of the country. That's 100% true. However, consider the market conditions we are in now. Global demand across the board is starting to collapse, and it's no different for China. China's now moving inwards. They're now focusing more on domestic consumption to ride out this global demand crash. The IMF has upgraded China's growth in 2023 to 5.4%, but 2024 is predicted to hit 4% because global demand is drying up. Beijing has to rely on their domestic consumer base to tide through the crisis. We can see Chinese consumer spending starting to decline in October. The overall economy is experiencing a slowdown. That's why we are seeing China sell off dollars to strengthen the yuan. A stronger yuan encourages locals to spend more. You get to buy more for less. In other words, China is moving more towards self-reliance, which isn't good for the dollar either. A weakening dollar means imports to the US becomes more expensive, and that adds more inflation to prices. It's the reverse of a stronger dollar, while China is moving just beyond currencies. Beijing is now wreaking havoc in the US debt market. For many months now, we have been saying that China will continue dumping their holdings of US bonds. They understand the geopolitical risk as well as the fiscal risk of endless government spending. It's not rocket science. You don't need to be a genius to forecast the obvious. In a not so shocking update, China's treasury holdings have dropped under $780 billion in September. They have been selling non-stop for 6 months now. Year to date, the holdings have decreased by $123 billion. The numbers are going down, and sure, some of it is collapsing because of the bond values going down. There's no denying that. When interest rates go up, bond values drop. That's just how debt assets work. But the trend today is so undeniable that China's really selling off their holdings. It's more than just a readjustment of bond values. There's a big hope that US-China relations will improve, especially after the Biden-Xi meeting. We know it ended in disaster with President Biden calling Xi Jinping a dictator, but let's go beyond that. We need to closely monitor the evidence. Is there still an economic war going on? Because if relations are really improving between the US and China, their bond value should be trending up over time like all the other G7 nations, right? China should be buying more instead of selling. And that might be the ultimate indicator of US-China relations. Russia is completely decoupled from the West, and that's why their US bond holdings today are zero. But here's where things get interesting. According to the Council of Foreign Relations, an American think tank, China's current account surplus is likely much bigger than reported. In other words, China is hiding how much money they are making. Their reserves are likely much deeper than we all expect, which to be honest isn't a surprise, right? China's not a very transparent economy. In the research, China's official surplus sits at $400 billion. That's a huge amount of money China can draw from. But they might be hiding the true scale of their earnings. If adjusted for total income, Beijing's surplus might be double the amount, nearing $900 billion, almost a trillion. That is a lot of money sloshing around. And this begs the question, where is China investing their surplus? They can't possibly leave it in cash because of inflation. Are they allocating more to the Belt Road projects? Are they secretly buying more gold? What are they doing with their surplus? But one thing's for sure, that money isn't being rolled into US treasuries. In fact, China is selling them off. It's minus $20 billion here, minus $30 billion there, but the amounts are adding up. A major bid in the debt market is going away. And that isn't good for Janet Yellen, who's still selling a ton of bonds to the market. Borrowing at high interest rates isn't sustainable forever. There will be a day of reckoning. This economic war is pushing the global economy closer and closer towards a recession. According to CNN, the average interest on the national debt is flying up. It's almost 3% for 2023. That's 1% higher than last year. The annual interest payments have also crossed 1 trillion US dollars. Congress is now in a big quandary. Fighting Russia is driving the US economy to further debt. At the same time, China's exit from treasury bonds is adding fuel to the fire. And it's not just China. There's a disturbing trend that shows the world is slowly exiting US treasuries. In a report by the Wall Street Journal, where have all the foreign buyers gone for US treasury debt? Private investors and central banks have dropped their holdings of US debt down to 30% today. A decade ago, it was 43%. More Americans are holding on to government paper than foreign investors. Where have they gone? It's easy. Many of them has gone to gold. They are investing in other assets that hold value. And until the US government stops borrowing money endlessly, this trend isn't going to end. So while America can keep the war effort going for now, the big question is for how long more? And guess what? We haven't even factored in the Middle East crisis yet. But let me know what you think in the comments below. How long can the West keep funding Ukraine? Will Russia collapse first, or can they really outlast US war spending? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.